Bitcoin's drop isn't what you think. Here's what's behind it and what comes next. Hey guys, it's Keith Allen. Oh my goodness, what a week we've had. The price action has not been pretty for bulls, not gonna lie. And a lot of forces at work, for sure, here. And we're gonna get into that here today, but my goodness, the noise, the chatter, the dissent, the despair, all of the stuff on social media is just it's reaching epic proportions. We're going to get into all of this here and more. First, of course, a brief introduction for those who might be new. My name is Keith Allen. I'm a full-time trader. I'm a work-from-home dad, and I'm co-founder of Material Indicators. And I am here to share some insights with you and some charts too, right? So, I would like to remind you guys that the live chat is open, and these streams are always better when you guys participate. If you've got questions, I'll do my best to answer them. If you have insights, by all means, please share them. A high tide raises all boats. So I want everybody in here who wants to join. So by all means, please do that. Also, if you would do me one small favor, I do this for free. Try and share some insights and share some data with you guys to help everybody trade safer and navigate this market and trade smarter. If you would do me the favor of smashing some buttons and help me grow this channel, hit the like, hit the share, invite a friend, or better yet, invite your whole community. If you're in a trading community, share this with them as well. So we can grow this thing together. And if you haven't done so yet, make sure you hit that subscribe button so you don't miss any of the future streams, because I'm dropping the free alpha all the time in here, and I don't want you to miss any of it. All right, so let's go ahead and climb in to what's happening. As I said, like, you know, it is so. I mean, it's getting comical to read the comments on social media these days. You know, you have one guy who will scream that tomorrow is going to be the start of the biggest bull run you've ever seen. I see that about 2 times a week from the same guy for weeks and weeks and weeks. I see another posting that we've been in a bear market for 2 years, despite the fact that, of course, we've reached, you know, new all-time highs this year multiple times. And then there are the declarations of alt season every time altcoins move like 2 or 3%. So let's just tune out all of that. Let's just take a beat and focus on the data and focus on the charts and try and figure out what is really behind this price action that we've been seeing. And so, like I said, lots of forces at work here. And I think the market, you know, in my view, right? And listen, these are my opinions, no financial advice here. This is my opinion. And if you have a different opinion, I'm open to hearing it. In fact, I'd love to hear it. I'd love opposing views. So by all means, don't be shy. But I think the market is doing what the market always does. I've been doing this in the Cryptoverse since 2017. And I've had my teeth kicked in once or twice. I'm not going to lie. But I learned from those experiences, and really, I think what has served me the most over the years is learning from those experiences where you get shaken out, or where you get your teeth kicked in, to help you realize kind of the psychology and the mechanics of the dynamics of how this market works. And I think that's where I excel the most, is just at studying how this market likes to work. And quite frankly, the market, in my opinion, is doing what it always does. From time to time, the market likes to punish the over-leveraged, likes to toy with the undisciplined and the emotional, and flush out those weak-handed, emotional, and over-leveraged traders. So you know, we kind of get a full reset when that happens, and I think that's happening now. And so there are a number of reasons why that could be happening. I have some theories, some of them more technical than others. And so let's talk about the primary forces at work and what's kind of leading to this momentum. So let's start with a chart, okay? And we're going to talk about what's influencing the chart and the price action, but let's start with the chart to get a baseline. So let me go ahead and share my screen, and I want to do that with, let's go here to the old candle chart on TradingView, and you can see lots going on here. Lots of lots of lines. Okay, and I'm going to apologize for all the lines here, but I'm going to explain what each of them are, and tell you why I keep them in play. So this is, let's, and I've got all this stuff here. I'll show you what that is too in a minute. So first, let me start by, I'm going to clean it up a little bit. You can see we have the trend precognition signals in here, and we got a beautiful signal on this downtrend here back on Tuesday, November 11th, earlier in the week, and things have just kind of cascaded from there. But this was, we saw this coming. And I'm going to show you why we saw this coming. But let me clear those out just so we can eliminate some of the noise in the chart here. Okay. We have that baseline. A while ago, towards the end of the month, I saw this death cross forming between the green 21 day moving average, and we saw it cross the blue 100 day and the red 50 day. Which were already wound up, right? We had this crossing here. So this was a sign that we could see things breaking down. We did get a brief rally out of this, and then here came the breakdown, right? And so we have another one about to develop. You can see the red 50-day moving average and the purple 200-day moving average are on an imminent death cross. And this is classic death cross, right? Like I call it anytime a lower moving average crosses below a higher moving average, that's considered technically a death cross. But the classic death cross is the 50-200 scenario that we're looking at right here. And this is an indication. Yes, these are lagging indicators for sure, but this is an indication that there's likely more downside coming. Hey, Ralph. Good to have you with me. Can we get an Aster analysis? It's holding well. Let me get what I'm doing here first, and then we'll circle back if we have time, and we can look at some other coins. Okay. So and I appreciate the follow, Ralph, and the question. So as you can see, and I even have the numbers here, so you can see what the levels are if you're following along at home. So this death cross is about to form here, right? Red 50 is about to cross below the purple 200. And that is a classic death cross, and it is one that we have seen many times before in Bitcoin's tender, 15-year history or so, right? And there's something very significant about this one. This particular move, this singular move, every single time, that's 100% of the time it has occurred in Bitcoin's history, it has led to a macro bottom. Okay. So I have these all highlighted. So let's just take it back to the beginning of time here. And because I don't want you to take my word for things, I want you to verify things. And since I know that most of you aren't going to actually take the time to do this, I'm going to show you what I took the time to do for you. Okay. So we have here, this goes all the way back to 2014, right? You can see here's the death cross and 26% drawdown from that point on to a bottom before finding its way back up, right? And then it occurred again, the red 50, the purple 200 crossed again. Oh, looks like I missed one right here. Oh, no, I didn't. I just made it bigger because this was actually bear market territory. Okay, so here's the cross, and we saw 70% drawdown into just a nasty move. Now, again, this is when Bitcoin was trading below $1,000. Okay, so it took it down to 150 bucks. But again, this was a long span of time, September 2014 to January 2015. Took several months to recover from that. Okay, and then again, we saw a much shallower version, and this might give you a little bit of hope here, right? They're not all 50, 60, 70% moves. Okay, here's a death cross right here, and it was just a 5.5% move to establish the bottom and work its way into the bull run. Okay, this was after bottoming. And so again, this was the low, came back and had a nice recovery, and then obviously, right, we're into another downtrend here, and then consolidating for working its way back up. So again, the positive sign here is not all death crosses are literally the end of the line. And when we are in a macro uptrend, seeing shorter ones like this is what you want to see. And technically, we are still in a macro uptrend until that structure is broken. It was tested this morning, by the way. So let's move on to the next one. You could see bullish, 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 up, up, up. This is where the so-called up-only narrative was born. And, we see it was a long time until we saw another death cross like that. But here it is in 2018. This was after the 2017 bull market. I was fortunate enough to enter. This is where I began my crypto journey. Was in October of 2017, when price was at 6,000. My first trade, the first $100 worth of Bitcoin I bought. I was trying to get it sub 6,000. I bought at the I bought a whopping $100 worth when price was at $6,001. Yes. Oh, if I had only held on to that one for life. I had no idea what I was doing. Not a clue. I just thought, oh man, this is amazing. And I added and I added and I added and I made money and I was very excited about what I was doing. And then the bottom dropped out. And this was my first trip to the school of hard knocks in crypto trading. And so we can see the next instance of a similar death cross, right? So in this one, at the end of that market, we saw this cross here, and we had another 60% drawdown. This was bear. This was full bear market, and then the recovery, and this took us to what? The 2019 top, and we went into another bear cycle. This time it was about 30% drawdown on this same death cross from, here you go, the 50 and the 200 down to a low, and then recovered. And then we had the COVID crash. Nobody could have forecasted that. That obviously took us down, bit of an anomaly here, but nonetheless, what happened after that, let's throw another one of these up here, right? After this, we got another death cross because that thing took us way down. That was another 30%. And then the recovery, which was absolutely epic. And we've enjoyed that until topping in 2021 up at 69K. Now, along the way, guess what happened? We had this kind of a fake out here, right? We thought this was the top. We had another death cross, 20% drawdown, and then a recovery rally. This is really thought to have been manipulated. Nonetheless, manipulation is part of the game here. I hate to say, still, and so it's reasonable to think that might still happen because manipulation is in part responsible for what's happening now. And I'll share that with you. I'll share some data with that, some data on that with you here shortly. And again, here's another death cross, right? The 50 crosses below the 200 and bear market territory. This is obviously after the 2021 top at 69K. Um, Everything drops out. It's a 65% drop, and then the recovery. Okay. Now, again, here's a bullish scenario where we're inside a bullish structure. We get another death cross, and it's just 8.5% drawdown. Now, again, we go to when is this? This is 2024. Last year, we did have another death cross between these two moving averages, and the drawdown was 20%. From here, we found a structural support test. Look at this. This took us to a support test here. We had another support test, kind of double bottom territory here, and off we went to the next leg up. And the next legs were absolutely beautiful, right? This is the 55K mark, and obviously the recovery since then is well documented. Again, in this cycle, 2025, we see another death cross. This time it's only 14% drawdown. And this was also it's hard to see right here, but we had a double bottom. Okay. So these always, every single time, have led to the bottom, whether the bottom is near like this or whether it is nasty far like this remains to be seen here. And that's what we're waiting to see play out right now. The good news is we had this support test this morning. And that doesn't mean that's the last support test, but it means that for the moment, at this moment, price is respecting the macro structure. And so what are these two lines here? So I don't like to redraw lines. I've stated that before. Let me just clear out timescapes for a second. I don't like to redraw lines. So this was the trend line I had drawn from the FTX crash as the market started to develop on this bull run. And as things kept going, as we got up here and here, it was like, you know what, this isn't really, the trend line the momentum has shifted upward. And so I drew another line here that has really been the lion's share of this particular cycle, since the post halving. So, but I did keep this here, and then I just switched it back on. I should probably switch this one off at this stage. And when we see it again, we'll know that we return to the trajectory. But this was really kind of the Trump influenced trajectory here at that stage. So I guess I could turn this guy off and we could go from there. Okay, so let's just say, here's our death cross, and it's going to form here in the coming, maybe it's going to form after the weekly close this week or next. By Sunday or next Sunday, we're going to see this death cross. So what would those scenarios look like in terms of drawdown? If we're consistent with what happened, we had everything from 5% to 70% for crying out loud. And it doesn't start from where the death cross is. It starts from where price is. Okay. So let's say it happened from right here and we ended up, that short 5% version. That's the one we really like. And let me switch timescapes back on here because we did see yesterday, we did get a support test at this timescape level. I thought it might actually hold for a minute. Didn't hold very long, did it? And now we have the yearly open timescape level in focus here. And this is really a critical range, in my opinion. In part because of the trend line, in part because of the timescape, in part because it's the yearly open. All of those things combined make this a very strong technical support range, in my opinion. Doesn't mean it has to hold, I'm just telling you from a TA perspective, this is very strong. Um, if things were to go down to that 20% range, like we'd seen in some of the examples over the past year, that would get us into that 78K, 75 to 78K range. These were prior consolidation ranges, I should note. And right, consolidation range here, consolidation range, et cetera, et cetera. Let me, again, I got to pull timescapes out to make it easier to spot those. Okay, so you can see all these consolidation ranges, which are, as we were building these platforms on the way up, and I was looking for these consolidation ranges, I had always said, hey, you have to see some of this consolidation so that if and when price does come back and retest, there's something for it to land on. So yeah, there's strength here, there's strength here, there's strength here, and there's strength here. So all of these levels could conceivably, serve as support. I think, from my perspective of this particular trend staying intact, then we need to see weekly closes above the yearly open, at the very least, the monthly close above the yearly open. If we lose this, then I'm hearing all sorts of levels be shouted out, and yes, that 74 level was a consolidation level for a minute, so that could come into play. We did have this double bottom support level here that could come into play, but I also think that the 2021 top is a likely candidate. I got a lot of flack for that in the past year or two, I should say, before we broke it. But I stuck to that 69K level, and it really, really seemed to play out. It held true. 70K at that point was psychological. This was the technical spot. So in terms of potential landing zones, all of these come into play. Timescapes add strength, in my opinion, and so those timescape levels are kind of serving like magnets. So I wouldn't expect to see something just happen, just happenstance land in a dark zone, not near anything, right? So what I say, that 75K was around these what is this, April? That's a Q2 timescape, and then of course, if we went lower, we're into this 2021 top range around that 20% level. No, that's not 20%. Let's see. That's closer to 30%. So in that range, in that 25 to 30% range, you could get all the way down to 69K. Could we see a 60% correction? Well, we could. I don't think it's very likely. And if we did, gosh, again, you see this puts us in a dark zone with nothing near it. I would say either the consolidation range around 40K, between this 45K level, or down here at 35K. I just, that is for me probably the least likely scenario. I just don't think that there's sentiment to see it go that low because of the institutional card. Because of institutional and sovereign adoption. And that's going to lead us to the next part of this conversation, which I think is a big reason why this could be happening. Two reasons, two forces at work here. One, for anybody that clings onto the halving narrative, this is, and you count the calendar days from the halving and, and whatnot. It's time, right? We had a bit of an anomaly where we made a new all-time high before we got to the halving. This threw a lot of people off, but then we did see a recovery, double topped up here, went down for support, came back up, made new all-time highs here and here and here, right? So this could be the end? Absolutely, it could. I don't rule anything out. But I just, for the longest time, I have been kind of holding on to the narrative that we have this institutional adoption coming. or growing, I should say, growing institutional adoption, right? The first wave was the ETFs. The second wave, quite frankly, is the one that's developing right now. And this, I think, is a big reason, at least I have a theory that this is a big reason that we're seeing some of this downward momentum pick up steam. Back in July, when the Genius Act was signed into law, the Genius Act and the Clarity Act were being floated at that time. To my knowledge, I think the Genius Act is the only one that's actually been signed into law so far. I think the Clarity Act is still has not made its way through the Senate, but that's another story. Bottom line is this legislation, in my opinion, kicked the door open for this next wave of institutional adoption. And I'm not just talking about more financial institutions that want to embrace ETFs and that stuff. I'm talking about onboarding. I'm talking about custody. I'm talking about banks literally building rails and even their own tokens, to get engaged in the crypto ecosystem. They're not just talking about it. They're literally building custody. They're building settlement rails, and they're building tokens. JP Morgan just launched their coin. Okay, it's a stable coin. JP Morgan literally, I think yesterday or the day this week, we'll call it that. This week, JP Morgan launched their stable coin on Base. Okay, so just moving from the testing phase, but they're moving forward. Okay, JP Morgan, remember Jamie Dimon of JP Morgan, the biggest crypto critic on the planet, is now launching a stable coin and onboarding clients into the crypto sphere. Okay, the JP Morgan will be allowing their clients to collateralize their Bitcoin. Yes, the same Jamie Dimon who called Bitcoin a pet rock. So this is going to be another wave of adoption, institutional adoption, that is going to be huge. And you don't think, at least I don't think, never did, and I said this back in July, didn't think these guys were going to come on board, come in hot when Bitcoin is in price discovery, making new all-time highs, or ETH, same thing. I always thought they would wait till there was a correction, there was a pullback, and they would come in and they would buy. They would load up when prices were down. And I also thought that they would get some help from the manipulator in chief. And we know how he plays the game. And we know that he's made some comments that have not helped Bitcoin price. And then, he'll come back after a dump and then he'll say something to try and bolster things back up. And I think the market is kind of getting tired of his shit. I think the market is finally starting to realize that he's so full of hot air that he has yet to really deliver on most of the promises he made, from a Bitcoin strategic reserve to the Epstein files. None of it, right? So what do you do then? I'll tell you what you do. You don't get married to the narrative. You don't follow the hype. You follow the charts. And what we need to see in the charts at this point, at this stage, because this death cross is imminent, right? It's happening. There's no avoiding it. What needs to happen for this bull market to stay intact, for this trend to stay intact, and we can wick below it, okay? It's okay to wick below it as long as we close above it. So the two things I want to see happen is what's happening here on the daily chart. We have this 50 moving average and 200 moving average about to cross. I mean, the moving averages are really wound up here on the daily chart. The weekly certainly looks better. And what we need to see here on the weekly is a weekly close back above this 50 week moving average. We had this happen last week, right? And everybody panicked. Oh shit, the bottom is dropping out. And then we recovered. All right. And everybody celebrated the recovery, but the recovery was short lived. And so now we're in a similar set of circumstances. It's certainly within range for Bitcoin to recover the 50-week moving average. So this is the two things that need to happen for this momentum, the bullish momentum to continue, for this weekly chart to continue to look good, because these moving averages are not wound up, right? We got the green 50, the green 21, the red 50, the blue 100, the purple 200. This looks great. And we just got a support test on the trend line. Okay. This looks good to me. What would change that is a close below the trend line. A close below the 50, also not a good look for us. So if we can get that close, the weekly close above the 50, that certainly would be comforting to a lot of people, and signal that maybe this death cross is going to be short-lived, and maybe we see it in that, that drawdown in that 5 to 10% range rather than the 20 to 60% range. I know that's a wide range, but I'm just telling you where it could go. So that's what I'm watching very, very closely. And on the daily, it's you can focus on these timescapes. So let's say we get an overshoot here of this moving average. Where can we go? Notice that this yearly open is just below the trend line. That's at 93.3K. And if we were to close below this, you just have a void. I mean, there's a black hole until you find support again. And if that were the case, just to go from the yearly open down to where the next range of support is, let's see, we're at like, from here to here would be another 10% or so, 12%. So that's not really anything anybody wants to see, unless, of course, you're a bear and you're short. Then you're quite happy about that. And, to that end, there's money to be made in both directions in this market. And it's probably a good time to be a bear right now, at least in the short term, pending, of course, how this plays out. Do we hold above this trend line? And do we recover this 50-week moving average? So what else do we have to discuss? What else could be there? So these institutions coming in, right? We talked about that. They have they got to load their bags. And is it going to happen fast? Is it going to happen slow? I'd be surprised if it's just like, oh, they buy one big dip and it's done. I would think they're looking for a consolidation range to dollar cost average, like everybody else wants to do. And so what are the different scenarios that could happen? Worst case scenario for me is, the death cross plays out and we break the structure, we close below the trend line, and then we just have a grind down into the depths of somewhere nobody really wants to go. I mean, the real worst case scenario is that 60% drop we talked about. And I think that would get us down here into that 40, 45K range. I don't want to see that. I don't think that is the most likely scenario, but I try and cover my bases onto, what could happen in any situation. My base case scenario is the fear and greed index drops. Yesterday we were at 15. Today we're at 16. This to me has done really the best when it's in those, when I say it's done the best, we start to see those macro bounces when fear and greed gets into that, like 8 to 10, 8 to 11 range. So I'd like to see that. I'd like to see it dip just a little bit lower and get down into these ranges. Right now, we're at 16. You can see there's been a few times we've dipped lower, and I'd be very happy if this is one of those times. Lowest I've seen it back in 2019 was at 5, and so those those uh, those dips into that 10% range, into that 10 range, really are interesting to me. So I'd be looking for that. I would also be looking for those weak hands to get shaken out and to see price consolidating above the trend line. Um, so that means we're, let's go back to the auto view. Okay, that means we're consolidating above this trend line. That yearly open is at 93.3, so we're consolidating above that 93K level. And how long does that happen? I don't know. Best case scenario is the best case scenario is that today's wick was the bottom, and I just don't see necessarily that we're there yet. And one of the reasons is what's happening with the liquidity game. So this is something that we have to watch too. And I talked about the manipulation a bit, and I want to show you some of the things that can illustrate that manipulation that we've seen. We have had liquidity stacking in on both sides of price, by the way, that sometimes doesn't have an intention of getting filled. Here's an example. I mean, this was like 200. This was over 250 million in ask liquidity, and it literally had no intention of getting filled. It was merely here to push price down, which it did, and then similar set of circumstances here. They started placing bids to move price back up, which it did. This isn't something that happens all the time, but it's also not something that's new, right? This is called, I refer to this as liquidity herding, right? These guys are like cowboys herding cattle, and or dogs herding sheep, right? They're pushing price. They're using their stack to influence the price direction, and it's working. A lot of times we go, oh, liquidity is a magnet. Well, sometimes it's a magnet, but sometimes it's when the magnet is inverted and it's repelling. And in this case, it repelled. In this case, it repelled. And here we go now. So what do we need to look for? We need to look for higher concentrations of bid liquidity to push price higher, because there's room to move here, right? There's about 32 million, 33 million in place at 100K. That may not sound like a lot of ask liquidity, but it is enough to hold price. I mean, quite frankly, 5 to 10 million is enough to suppress price, unless there's real sentiment to buy, which you're not seeing right now. Here's another issue. We have this divergence between brown mega whales and purple whales. They're all binned by order size here, and it's making it difficult to identify just based on order flow on the bin CVD. So you can gain a lot more. You know, this is at the moment a trader's market, in my opinion. We're in this range and we're just hitting, bouncing from the lower the range to the high of the range, etc. So keep that in mind, that you can gain probably more insight from seeing, watching the dynamic movement of liquidity than you can from just watching the order flow here. Now, obviously, if all the order flow is going in one direction, it's easier. This is a different set of circumstances. Also, don't be fooled into thinking that this yellow order class, the smallest one, $100 to $1,000 orders, is strictly retail. Yes, retail lives there, but some of these larger institutions are using this order class to trade without slippage, and it's working, right? They often counter trade whales, but they are whale controlled largely. So where else can we gain some order flow insight? We can look at ETF flows. And ETF flows for Bitcoin yesterday were absolutely brutal on the outflow side, 866 million. Now, do not fall into the trap of thinking that the institutions are unloading on you. This is not BlackRock and Fidelity unloading on you. This is their clients reducing their exposure. This is their clients de-risking. This is their clients profit taking. Okay. So this is not the institutions dumping on you. They execute what their clients request. They execute their clients' orders. But obviously, we had a bloodbath yesterday on the Bitcoin side, the ETH side, smaller but also pretty heavy. What is remarkable to me is why that ad popped up. What is remarkable to me is that Solana just quietly on this little streak of accumulation. Don't know who's doing this, but somebody obviously has a lot of confidence in Solana here. So one day does not make a trend. Keep that in mind. But yesterday, obviously, a rough day for the market in terms of outflows. So there's that. The other metric that we can watch in terms of flow and risk appetite is this chart right here. We have Bitcoin dominance in orange. We have total 3ES, which is the top 100 altcoins by market cap, top 100 coins by market cap, including Bitcoin. I mean, excluding Bitcoin, ETH, and stable coins. Then we have ETH dominance here. ETH dominance getting a tiny little uptick today after declining, and stablecoin dominance. Stablecoin dominance skyrocketing right now. We saw something similar at the beginning of the month, and that's something to watch, right? This is a sign of de-risking. Now, if you saw this declining and everything declining, right? If you saw Bitcoin dominance falling, total 3ES falling, ETH dominance falling, and stablecoin dominance falling, that would be a sign that money is leaving the market. This does not mean money is leaving the market. This means money is rotating out of Bitcoin, out of alts, and at the moment into stables. In other words, they're stacking powder so they can buy and take advantage of opportunities. And opportunities are coming, right? So at this stage, what you should be doing is identifying your targets, identifying, what assets you're trading. Alts, I would be very, very cautious with alts. If you're trading, I would be very conservative with your profit taking, right? This is what I call take the money and run season. Not hold out for those big gains. Just take the money, move on to the next trade. Take the money, move on to the next trade. Probably the safest way to trade in this environment. And in terms of the macro, at the moment, the structure remains intact. And before you panic, before you dump it all, before you sell the bottom, get some validation. All right. Let's wait for a weekly close. See what happens here. See how this plays out. A weekly close below this, not going to be healthy. Not for bulls. Weekly close above it, the macro trend is still intact. And then, of course, a weekly close above the 50-week moving average would be very, very good. I'm not convinced we're going to get that. I do think that it's likely that we would see some consolidation here before we get that, some consolidation perhaps around this trend line before we get that, at least above the yearly open before we get that. And then a move up. Now, in terms of this death cross, it could be a deep death cross. It could be a shallow one, right? We have no idea how many weeks it's going to take for this to recover. But when it does, when that golden cross between the 200 and the 50 finally occurs, that's going to be a sign that bulls are back in control. I hope that has given you some insight and just some data points that you can actually follow and help you formulate your plan and stick to your plan. Do not get caught up in emotion. Do not let emotion rule your trades. Do not let narratives rule your trading decisions. This is not a time to stick to the narrative. Don't get married to the narrative. It's a time to look at the charts and make those decisions based on what the data is telling you. And if you make those decisions now, before you're in the heat of the emotional moment, then you don't have to make an emotional decision. So make your decisions now, set your orders, set your stop losses, set your stop limits. And when it happens, just let it happen. Resist the urge to overtrade. Resist the urge to stare at the chart for 24 hours a day and psych yourself into pushing a button that you don't want to push or one that you're going to regret. And if you don't have the appetite for it, two things. One, sitting on hands is a strategy and out is a position. You got to do what works for you. Going to leave it right there, guys. Hope that helps you out. Hope that helps you trade smarter. And I hope that you have a great weekend.